Hey everybody, I'm really excited to announce that today is the launch of FreightWaves Playbook. This is a first of its kind offering by FreightWaves where we take all of the secrets of how to be a successful trucking operation, really gathered from the biggest and most successful players, and offer it to the smallest operators. This is really taking the information, the secrets of how these companies operate and create enormous amount of profits in their business and offer it to operators that often don't have the resources or the experience that the biggest operators do. FreightWaves Playbook brings together data, information, and content into a package that any small operator can have access to. We built this so that really you're getting day-to-day information about how to operate your business based on what's happening in the market using FreightWaves News, data about what is moving and where it's moving so that you can operate it, and long-term guides through our masterclass product on how to operate more successfully. This is in partnership with Adam Wingfield, someone who's been doing executive coaching for operators for years, and bringing it into a product that you can subscribe to and really help your business be more successful. The goal is to help you understand and have access to the resources that really drive best performance in this industry. So sign up to FreightWaves Playbook today. It is launching. You can go to FreightWaves website to learn more. Really excited to have you participate in what we believe is the most exciting launch that we've done in years.
Hello and welcome everyone. Thank you so much for joining us for today's State of Freight webinar. My name is Julia Becker. I'm the Vice President of Media Operations here at FreightWaves. I'm joined in studio by FreightWaves Founder and CEO Craig Fuller and Sonar's Head of Freight Market Intelligence, Zach Strickland. Today's conversation will cover insights from our Sonar platform, as well as a forward look at what's ahead for spring. Craig and Zach will also answer your questions at the end of our discussion today. But before we get started, I want to cover just a couple of quick items. If you have any issues during the webinar, you can reach out to our team via that audience chat function in your webinar console, and we'll be in touch to assist you. If you have questions for Craig and Zach, enter those in that Q&A box also in your console. And like I mentioned, we'll roll through as many questions as we have time for at the end of our discussion today. We'll also be sending a link to the recording of this webinar to you tomorrow in case you'd like to watch it on demand or share it with your colleagues. Now I'll go ahead and turn it over to Zach to kick off today's discussion. Zach, let's jump right in.
Thank you for that, Julia, and thank you all for tuning into this webinar, however you are viewing it. Zach Strickland here with Craig Fuller, our CEO. And Craig, I want to kick things off by just saying, we've had February, most of February at this point. Last time we talked, tariffs were in the mix a little bit. What have we learned over the last 30-ish days regarding some of the policies and the tariffs and its influence on transportation and basically the economy?
I don't know that we've learned anything.
Yeah. Okay.
We've learned a lot. I feel like we've learned nothing. I think at the end of the day, the reality is that Donald Trump's willingness to implement policies really quick without a lot of warning is certainly in vogue. And I think the issue or the challenge is that you really don't know what's next. And I think regardless of whether you're pro-tariff, anti-tariff, pro-Doge, or you think it's the worst thing to happen since, whatever, it's very hard to predict what's next. I think what we've learned that Donald Trump made a lot of promises during the election, and we're getting exactly what he promised. And so whether you wanted that or not it's happening really quick.
Yeah, I think we're seeing, we've been talking about uncertainty for the past 2 months, really. But that seems to be the overriding theme, is that people just aren't really sure what to do about things as we progress until we get some clarity on it. And I think we're seeing that manifest in the form of inventory pull forward. Mm-hmm. We still continue to see that in a lot of our imports. Import volumes, I believe, Los Angeles, Long Beach, breaking records for January.
Yeah.
So that continues to be a constant struggle for a lot of these companies to figure out, okay, regardless of what we think about demand, what are we going to do?
I think reality is my sense of it, and I said this before, is that the threat of tariffs and generally Donald Trump's policies towards tariffs is generally good for domestic trucking freight. Like at least short term, some impact. I still contend that's the case. I don't think anything has changed my thesis there. What I do think is interesting is the speed at which the DOGE, whether it's either you blame Elon Musk or credit Elon Musk for DOGE's impacts in the economy, the fact is that there's a lot of attention to those government. I mean, the U.S. government and government organizations that are recipient of U.S. tax dollars is a massive part of our economy. Something like 35% of GDP is tied to direct or indirect spending of government spending. And so when you start pulling back and threatening that entire system, you're going to have some slowdown. And we've known this from the freight data that we saw during the initial COVID surges, is as the government was putting these programs into place to create stimulus, it shows up in the freight data really quick. Whether it was PPP or the COVID stimulus bills, those dollars show up really quick. And so one of the things I'm really watching is this a lot of noise? Like DOGE has certainly come out and talked about these programs and the dollars. When you talk about $50-60 billion, feels like a lot. When you look at the size and scope of the U.S. budget, it isn't a lot. But what is happening, I think, is creating some, if you're running an organization that is dependent upon some level of government spending, you're probably operating pretty cautious. And I think that's going to create a drag. And then consumer confidence that for those people that work in those businesses also. And it's not just the federal government. It's all, it's states that are dependent upon federal funding. It's local municipalities. It's nonprofit NGOs. It's even for-profit companies. It's anybody that has government. So I run a business at Firecrown where we own a bunch of train magazines. One of the primary advertisers in these train magazines are railroad history museums that sort of feature the Western expansion tied to the railroads. A lot of those museums are dependent upon grants from the federal government, some historical preservation grants. We have seen those advertisers pull back sharply due to either losing funding or the threat of losing funding, and they're going into sort of a bunker mode of trying to just protect whatever resources they have. That is certainly going to drag things. I don't know how big the number is, and I think it's too early to know. What we do know is that freight has slowed down in February. The hard read is that January, if you sort of go back to pre-COVID, and we should pull the data up because I think it's really important, but if you go back to sort of pre-COVID, January was a pretty sluggish month. It really was in 2018, I think, is when we started to see it become a better than it had been month. February has always been weak. February is the weakest month of the year, and that continues.
Without a holiday.
And we've always been, well, you could argue that you have President's Day that is now, I think, is getting celebrated as a holiday a lot more.
Sure.
I don't remember ever being a holiday when I was a kid, but all of a sudden it's winter break for at least my kids. But I think it's having, it has some residual effect. But I do think what we're seeing is like the cycle, the freight cycle. January, we said this in January, I think we've sort of have been caught off guard a few times. This year, we didn't get caught off guard on saying January was great and this must be a new cycle. I think what we said was that January is hard to get any read, and I think that's consistent. What we've seen is that February is softer than I think a lot of us anticipated.
Yeah, let's pull up the OTVI and talk this through from a data perspective. And we don't have the pre-COVID up here because that makes the chart a little bit noisy. So typical seasonality is what you're talking about. Pre-COVID was that January would be kind of a big drop off from the holiday volumes, and we'd lull all the way through February, and then some point into February, early March, we'd start to see this pickup. That is a little bit present here. The hard part about looking at the white line, which is the current year, is that there may be a little bit of artificial inflation because of winter weather.
Winter weather's been, this has been one of the most severe winters that we've had in many, many years.
Yeah, we've had some really significant transportation disrupting storms, and the last 2 years really. And I think we're seeing a little bit of, death by 1,000 cuts. This drop that you're seeing in February is exacerbated by a little bit of an overheated January, not literally, from a transportation standpoint. And then we also have this typical, you can see these little dips that occur this time of February in the last 2 years. We're seeing a little bit of that. Some of that is also a derivative of import volumes, as you have this Lunar New Year impact where, imports have trailed off after they get, largely imported and pull forward activity. And that's a big portion of this.
And that's different this year. It's earlier this year than it was.
Yeah, it was January 29th this year versus February 12th last year, I believe. And so right now we're in that weak period where a lot of that freight landed in the port of Los Angeles, Long Beach.
And imports are representing a larger percent of freight than they had in past.
Way more.
As the sort of domestic market
Yep.
has been relatively sluggish in terms of manufacturing. So it is certainly a factor where imports do have a much larger factor. Now, the good news is, I think, if you look at bookings data, which you've got, if we're going to pull that up, that would be great. IOTI.
Let's go.
If you look at sort of the container bookings data, it is, it's hard to see, but what I do think is interesting is that it's coming back and it's certainly on the rebound. You've got to go a couple weeks into the future before you'll see the impact of that.
It's about on par with where it was this time last year.
Yeah, even arguably higher. But my point is that the imports, when they come back in March, should recover a lot of that sort of softness in February. February's always soft, and I think I'd be reluctant to draw too many conclusions about January or February, just because January has not been typical since COVID. February has been typical of every year, but it's hard to get a read. I wish it was more robust. I mean, if I sort of look at what I hope we would be seeing is a much more robust February than we've seen. But it's also, you've had some pretty significant winter storms, even going as far south to Florida. Like we had that weird winter storm that was in January.
Yeah.
A couple weeks ago. And then you've had this recent cold snap, which I think is like the coldest in 35 years or something?
Yeah, it's diving through the Midwest and into Texas. Once again, their power grid is still up though.
So all of that is a factor in how the market's playing. You had the California fires, which also I think do play a little bit into this. You had the hurricanes out in North Carolina that played into this. The recovery effort and rebuilding is slower than I think we've seen in years past, because one of the things about, we always end up talking politics, and it's not necessarily what we want to be talking about, but I think one of the things that's happened is there was so much pressure on the Trump administration coming in, and I think really anybody coming in, but certainly the Trump administration coming in to talk about cutting government stimulus. And what we saw back in, say, 2017 when Hurricane Harvey, there was actually a view that stimulus or government funding was good. There was no question. No one was questioning at that point Donald Trump was in office on whether he should be pumping billions or Congress should be approving billions of dollars in funding. That didn't happen this time around. It was a much more politicized politics. A lot of it was sort of pulled into these other stories, whether it's immigration or not. And I think for part of that, it's the reason that some of that sort of surge has taken longer than what people would prefer.
Yeah, I think too, the insurance situation.
Insurance markets are all messed up.
Very different there. We've seen it here in Chattanooga where recovery takes a lot longer than it used to.
Yeah. And then you have California. The question is, how long are they going to, do their building codes and a lot of the zoning
so much
issues
more.
And just the bureaucracy that exists, is how long will it take before they get back to building? And those are big questions that I think that's overhanging the market. I think those are sort of bookends. The broader story is what truly is the economy right now, and how healthy is the economy? And I think we saw Walmart's earnings report. They blew out their number. They had a really strong number, but they started to warn about consumer softness. Again, you have to wonder how much of this is just consumer confidence. They're hearing all the noise around government stimulus, particularly people that are living, that are dependent upon government programs, whether they're actually direct recipients or through EBT, SNAP, welfare, or indirect through an organization or company that's dependent upon government spending. The question is how much of that is going to impact the consumer. And I think that was, the tariffs were on everybody's radar. And we talked a lot about a change of administration. I don't know that I certainly understood or appreciated how fast DOGE would come in and just blow up or attempt to blow up some of the government programs. That feels feels like a relatively new development. I don't remember spending a lot of time talking through that.
In a lot of the conversations I have with, companies and people in the companies, I think the nuance here this time is that there's so much going on that it's hard to see through any kind of clear path. Even though some of the Doge activity may not directly influence people, they're hearing, levers.
It's fact. I mean, look, it's everything that people thought they were, at least people that voted for Donald Trump and people that didn't want Donald Trump. It's pretty much playing out way everybody thought it would.
Yeah.
I think what we have forgotten about was what a Donald Trump presidency is like from a media standpoint.
Right.
Is that things do happen fast. They're very unpredictable. And I think a lot of that is sort of playing out in real time because we don't necessarily know. And I think it does at some point impact consumer sentiment. It impacts business investment. I know in some of the sectors that we have on the Firecrown side, on the media side, the boating market's really soft. It's starting to show up a little bit in aviation. Some of that the wealth effect is actually is now, even though the stock market's doing well, some of these higher end affluent categories, which have been fairly insulated from economic cycles, are starting to feel tired, and we're starting to see that in some of the data.
Yeah, I want to divert back over to the trucking side of things a little bit here because we've been talking about a lot of demand side processes. It looks like it's hard to say anything definitively when we see softness in February. I told somebody the other day, I was like, I'm not really going to make a lot about softness in January, February, especially if it outperforms the softness I expected. But I would make more of it if we were outperforming to the high side in February. But the thing that is surprising me in all this is the tender rejection index. And this is the percentage of those tenders and the OTVI you were just looking at that are being rejected by carriers from request to shippers, so from shipper requests. And this has been, I know we have a little bit of a drop there from January to February, but that was before the OTVI
I'm not surprised about it at all. I don't know if you were about to say that you're surprised that it's held up.
No, unpack, go with that. That's basically my question.
I mean, I'm not surprised at all. I think we made the case, if you sort of play the tape. I wish we could you could throw down, that commercial where they can throw down the flag and you go back to the tape.
I think you're going to make the point that I want you to make.
We should do that. You should be like, that's not what you said, Craig, and throw it down. Because there's people here that would love to throw the flag on me at times. So just to be clear. But I think if you go back to the tape and what we talked about in the fourth quarter was the volume was not the question. The volume in trucking volume has never been that robust, at least the second half of the year. That was not what was keeping the market afloat. That was not the recovery. In fact, when you look at the freight recession conversation, it was always the capacity situation. It was never really about super high surge because that wasn't in the data. And at least in 24, we were not talking about high volume and high surges that were creating the market recovery. What we were talking about was the capacity situation getting better or more balanced. And that has continued to play. I mean, look at this. You have the white chart here, tender rejections. Remember, tender rejections show the percent of freight that's rejected. A high rejection number or an increasing rejection number would indicate a tightening market, and a lower rejection data point would indicate a loosening market. What we're seeing here is, what we call really sluggish volume compared to what, not great volume. And in spite of all the other elements in the economy, what you're actually looking at is that tender rejections are in a pretty good spot compared to where they had been over the last couple of years. I mean, look at the green line. You're well above of the mark where you were last year. Yeah. Look at the pink line. You're well above that line as well of where you were 2 years ago.
But OTVI has dropped below that pink line.
Yeah, so it is telling us what we wanted to hear, which is capacity has reset, and that reset is continuing. I've been incredibly busy last couple weeks, and I found this out this morning. A friend of mine asked what I thought about the Jack Cooper bankruptcy, one of the largest trucking bankruptcies in history. And I'm like, I'm so out of the date, of what's happened the last couple weeks. I've been doing a number of things that I was like, what are you talking about? They went bankrupt. And I realized that we had covered it, but it had that whole week, I was sort of out of it. That's a big bankruptcy. And I think two things are happening. One is we've had so many big trucking companies over the last 5 years that have sort of filed bankruptcy that we all kind of expected there to be a big story. Some of it's on me for not paying as close attention during that period of time as perhaps I usually do. But that's a really big bankruptcy. And I think it's just another example of capacity leaving. In fairness, it's auto transport. It's not tied into the broader van market. Right. It's not going to show up in the data. But it does sort of show that capacity is leaving the market. And while that story is unique to Jack Cooper, it will create some level of disruption and waves inside the market.
Yeah, hauling cars, of course, different than hauling a dry van behind it, but that driver community is the same, essentially.
Yeah, it's Teamsters.
Yeah.
I mean, they're Teamster unionized drivers, but they will likely pick up a job somewhere else in trucking jobs. And while it may not be a union driver hauling cars, they will end up driving something. They will be absorbed by the market. I mean, generally, we continue to want to see capacity churn out, and there's no reason to think that that's slowing down. Lots of reasons to think that that's continuing to play out, and some could argue it's accelerating. The softness, if you will, in February is a good thing.
Yeah.
For a perspective of capacity balancing.
From a long-term perspective, this is sort of what you want to see if you're able to hang in there.
And one of the things is, remember, and I've had this conversation, people ask, what does it take to stop having new fleets enter the industry? It's ultimately the banks.
Yeah.
When the banks lose confidence to lend money, the lenders decide they're not going to lend money. And so when we talk about LTL, yellow bankruptcy, we talk about Jack Cooper, an auto hauler bankruptcy. While that may not impact trucking, bankers don't know the trucking industry that well and aren't paying attention to it. When you have a big bankruptcy like that, it takes the whole thing down, if you will, and the confidence of the lenders to lend money. And I think those things are generally positive if you are operating in the business and you're not Jack Cooper.
Right. I wanted to talk about the last chart we had up there, the carrier details, net exits, basically. Net changes in trucking authority. So when it's green, that means there's more entrants than exits. When it's red, there's more exits than entrants. And we have been pretty consistently in the red. Now, this is not necessarily a data point that you really need to look at weekly, but it is helpful to see over a long period of time that we've seen a lot more exits than entrants, and that persists. So, some of the questions I get asked are, well, you said the freight recession was over in November. Why are we still seeing this amount of revocation?
You're going to still, we've talked about this before, but I should reiterate and restate it again, is that your bankruptcies and the churn number will continue well past the recovery. Right. It's just always that way. Balance sheets have memory. And even if you go back to when the market was accelerating, or when it first collapsed, I should say, back in 22, we were seeing new entrants enter the market, and still the number was growing at a time when the market was collapsing, because it takes a while for that information to filter to all the participants in the market that there's a problem.
Right.
And lenders are still lending money, and were still lending money all the way through 22. And so that made it easy for people to get into the business, because ultimately if they can borrow money, they can go get a truck. And what we're seeing now is that the lenders, that tightness in capital, I think at the end of the day, I've been told I say that word quite a bit, by the way. So, but I'm trying to avoid that.
By somebody in your household, I would assume?
No, it was a friend of mine who was a friend of the show.
Okay.
I won't call them out because I don't know they want to be called out. But he commented, he's like, you say that a lot. And I just thought about it. So if you're listening, I appreciate it.
Good note.
But I think what I can't avoid not saying. I think what we're seeing is that the lenders are going to determine the pulse of the business. And when you have uncertainty, I talk to a lot of bankers in both my business, but also my personal life. Just have a lot of friends that work in banking. And what I'm hearing is just how reluctant they are to sort of, they're risk off right now.
Right.
A lot of it is pressure and uncertainty in the economy. that does tighten up things. That hurts the demand volume side, but
Right.
it also hurts trucking
Okay.
from being able to go out and borrow money to buy trucks and stuff because
Right.
they're not willing to lend. They're not aggressively lending. I think that's showing up. I mean, one of the things DOGE has mentioned looking at the SBA, SBA is a primary source of capital for this
Right.
industry. And DOGE, one of the reports was that DOGE was actually narrowing in on some of these SBA programs that were put under Biden. Well, that will make a lot of the bankers very nervous. The consumer protection, the CFPB is also, that's the sort of safety and security arm that regulates consumer activity in the banking sector. Whenever you blow up a regulatory regime,
Right.
whether it's good or bad, banks are not the types of organizations that say, hey, my regulator is uncertain.
Right.
I'm therefore all of a sudden going to do all this stuff. They actually sort of do this bunker mode of like, I don't know what's going to happen. And so that ends up making them less willing to take risks. All that is generally good from a capacity standpoint. I don't know if it's good for the broader economy,
Right.
and I could argue why it wouldn't be. But ultimately, we've been watching this capacity map, and any kind of reset to the capacity map, I think is super positive.
Yeah.
By the way, I want to be very clear. I think we don't have a choice to address the government spending over the long term.
Right.
I don't think anyone would dispute that.
Right.
And so whether we take the pain now or take it in the future, it has always felt inevitable. It's just that it's happening at such a quick pace.
Yeah, true that. But I think it's fascinating that you just basically said that yes, while the current environment is limiting to demand, it's also limiting to supply.
I think
that's fascinating.
I think the most important thing to keep in mind is that we have to get rid of the supply.
Right.
And I think if you're looking at what is more bullish for our industry, which is what we ultimately care about,
Right.
is the economy is going to do what the economy does. But what we have suffered through for the last couple of years has been entirely based on too much capacity. And it was really caused by massive amounts of excess capital going into the economy, funded by your and my tax dollars and our printing press and the government printing press, that enabled the market to create so much excess capacity.
The bubble.
It created a massive bubble. And that bubble burst, but it burst so relatively slowly for a couple of reasons. One is that the government stimulus programs that pulled back did not necessarily take all that money out of the economy.
Right.
It was still floating around. It was tightening, but it was floating around. Mm-hmm. That was one factor in it. And the second factor, which we should talk about, just because it is top of mind, is the immigration story. Is like, not only was it the ability to hire ability to buy trucks and get financing, but it was also the availability of labor, drivers. And a lot of these a lot of the folks that were driving trucks were documented refugees that came in from like Ukraine or came in through some of these government programs. Whether you like them or hate them, they are a factor here. And I think that number is much bigger than any of us ever paid attention to, because it happened so quickly.
Right.
And it happened in parts of the freight economy, which, unless you're on the ground, drivers were telling us this was happening. Right. I didn't believe it was actually a factor to the degree that it was. Mm-hmm. I started to dismiss it as somewhat xenophobia. And what I learned as I got into it and dug into it and talked to a lot of people who were much closer to that data and closer to the incidents, it's actually a much bigger issue, that we've had far more undocumented immigrants and documented immigrants that were legal but had sort of work permits that were allowed under some of these programs that actually kept the labor supply pretty fluid. And when you have those factors of free excess money and excess labor, that is what's kept a lot of these businesses afloat. And that's a big problem if you're in the industry operating. We're seeing that now pull back. And the reason, we can look at demand data all day long.
Right.
The reason I don't think we have to spend a ton of time talking about demand is that demand is not going to answer whether or not the recovery continues. It is going to be largely answered by, does the capacity map continue to reset?
Right.
And if you can get rid of carriers faster than you add, then if you get rid of carriers faster, then the slowdown in the demand side then generally that's a good thing. And I think that's what we're all betting on.
Well, I think it's fascinating that you're basically, and I know that the immigration situation impacts much more than just the transportation side.
I think it actually impacts far greater part of the labor economy than it even does trucking.
Yes.
A lot of it's anecdotal. I mean, there is a large number of just the data, but a lot of it's anecdotal. But there are a lot of jobs that trucking competes with: hospitality, food work, restaurants, agriculture.
And any carrier, anybody that's been an operator or a carrier knows that it's drivers,
construction,
that really drive the
it's all
supply
about drivers.
side.
It's all about it's about the labor supply.
Exactly.
And I think when you have a situation where you have trucking is an interesting job because it's actually fairly easy to stay on the radar. I mean, you see these raids that are happening around the country, and what's happening is, ICE is going into these chicken processing plants or these places that migrant workers, these houses or complexes where they tend to aggregate. A lot of charities are like, wait a second, we maybe they had sort of an open policy and they sort of pulled back because they don't want to get caught up in it. And so what's happened is they've all sort of come, they're not congregating as much in these sort of like usual places. And what's happening is that trucking offers a really nice way to sort of get out of the way.
Right.
And I've heard a number of stories of where that is exactly what's taking place, is that they're driving team almost nonstop.
They're on the road, they're moving targets.
They're on the road, they're moving targets, and they're not, the worst thing that you could do if you're someone who's here that's not documented is to be in a place where the government's ICE is going to go, and they're going to go to the usual suspect. They're going to go to these, meat processing plants that you find them, these big agricultural fields where you find a lot of folks. That's where they're going to show because that's where they're able to get these big splashy raids.
Well, and we, and I'm curious to hear your opinion here. Last year was the first time we saw Road Check Week show up for a while.
It was, yeah.
Do you think that the immigration do you think people were more nervous about that, and therefore there were a lot more?
No, remember, Road Check was under the Biden administration, and the Biden administration was not. Was definitely more accommodating.
Right.
And I don't think so. I think what happened at Road Check is that the capacity reset was already happening.
Right.
And I think because it was happening, I think a lot of drivers just didn't want to deal with the hassle. And like even if your truck is completely clean, like no, who wants to deal with the hassle of having someone inspect you? You're gonna, I think one out of every 5 trucks or something has gotten some type of citation.
Right.
Who wants to deal with that? It's like having to do a TSA.
Well,
like I am not a terrorist. And when I go to the airport, the thing that's massively frustrating is having to get every part of my bags checked and patted down. Like I'm not a threat.
Well, also when you're not
but you know why that exists. And if you're a truck driver, why do you want to put up with it?
Also when you're not making a lot of money to begin with.
No.
Why would you put that?
The hassle's not worth it. So take the week off and not deal with it. I mean, so I think all of that is a factor, but I think the reason we saw it last year was the capacity map was resetting.
Yeah.
And as it was resetting, it was showing up. One of the other things, to Adam Wingfield, which should shout out to what we talked earlier on, the pre-roll video.
Right.
is Playbook, which we did in partnership with Adam Wingfield to help the smallest carriers figure out the playbook for how to compete in an industry, taking sort of the best of the best and the ideas and giving the smallest guys in the business a chance to compete. We launched that. One of the things that I learned from Adam Wingfield is the whole drug and alcohol clearinghouse. And that the sort of second stage of that went into effect back in November, which was basically removing these guys from the role and requiring that they are. And what I found out that Adam shared was the question has always been the enforcement of okay, if you're in the alcohol, drug, and clearinghouse, what keeps someone from not hiring you?
Right.
Nothing, except if they do hire you and you're not, or keep you employed and you're not legal inside that drug and alcohol clearinghouse, then you're subject to significant thousands of dollars of fines. Mm-hmm. And it's the states that end up leveraging that. And if you think about, states are looking for every source of revenue right now, particularly with the federal government. It's like, hey, we're not doing this anymore.
Right.
We're not playing the same game. The states are going to start really thinking about, okay, where can they get funding? And these big fine programs are very attractive for that.
So, I mean, we talked about this.
So that will take, my point is that will take some drivers off the road.
I mean, it has to, right? But it's up to the states to enforce it, correct?
It's up to the states to enforce it, but remember, there is money tied to it.
Right.
And I don't think I think one thing I would say is, you can argue that a lot of the immigration stuff is highly politicized. And whether you're sympathetic or empathetic to the migrant population, or you're much more strong-willed about how you view that issue, I don't think anyone is going to argue that keeping drivers that have had alcohol or drug issues off the road is controversial.
Right.
Like, no one's not, like, you're not losing an election because you took some dude off that has an opioid addiction.
Right.
And you got him out of the trucking industry. Right. Like, you're not getting, like, that is not a political issue.
Sure.
That is a safety issue. And I think that becomes a pretty attractive target. Now, whether or not they'll enforce it, I think is anyone's question. They have the incentives, and ultimately incentives drive everything.
Yeah, so I want to land on two charts here. The first one being the National Truckload Index, line haul only, excluding fuel, basically a measure of spot rates. We've seen this basically follow what I would call, outside of that middle of January thing again, a relatively traditional playbook as it slides throughout, the back half of January and into February. We had a little bit of a hiccup there, more of an anomaly than a trend line change. What would you say about the spot market right now as it exists?
I don't know. I consider this better news.
Okay.
Looking at that chart, it was following. If you look at the pink chart, which would have been 2023, and you look at green at 2024.
Yeah.
You saw, and again, that's winter weather that happened in that February thing. But look at the fact that it broke trend on green.
Yeah.
Back in, and it has not fallen that far.
Right.
It has not followed the direction, the trajectory of the 2024 chart. And then you have tender rejection data rates that are in the mid fives. So if this is the worst, then I think anyone who's been around trucking for a long time, short of some economic issue or some type of political issue, I mean, not political, but like a geo issue or, natural disaster, would argue that generally February is the worst month of the year.
Right.
If this is as bad as it's going to get, I mean, what are we at, $1.71? $1.71 is maybe break in, maybe break even, maybe slightly, maybe we're losing a little bit of money in the industry, and this strips out the fuel cost. It's about break even. That isn't that bad. Now, I'm going to get some hate mail on that because they're going to be like, the rates suck and you don't even talk about it. But the fact that in mid-February, it's where it's at the time Chinese New Year is also in effect, I think I consider this a positive.
Yeah, and I think I've been looking at the spot market as the effective bottom end of the market in terms of rates.
It always is.
I mean, but at least truly until the market flips. And then
market flips, but it's usually, remember when you have a normal market, spot's always below contract.
It's the most negotiated rate.
Where are we at on rates there, Zach?
That's the next
pull up my
chart.
favorite slide.
That was the chart I was going to end on.
I love rates.
So, and we see a totally opposite trend line on rates that we see in the
this is why you should get encouraged. Positive news.
There we go.
is, remember, the market inflection is all about relative supply and demand. But the way to sort of know where we're at in the cycle is that inversion, or that delta, the spread between contract and spot. And what rates tracks, rates.usa, if you're playing at home, what it tracks is the delta between those two numbers. And if you go back to pre-COVID levels, back to 2019, or pre-COVID levels, but certainly in 2019, the delta was 35 cents a mile to 50 cents a mile cheaper for spots. In other words, I could buy spot capacity 35 to 50 cents a mile cheaper. And what we saw during the collapse in 22 is this massive, massive spread of about $1 a mile. And we've seen it increase really throughout, really since that low in 22. 23 got progressively better. 24 has gotten was much better now in 25. And I will contend that February is the softest, if assuming nothing catastrophic happens.
Right.
This will be the softest set of weeks of the year. Pinpointing when in February something's really the softest is always hard to do, but like this will be the softest period of the year. The fact that that spread number is that near that 50 cents a mile and hasn't gotten much worse, to me tells us again we are largely in a recovery phase of the cycle.
Yeah, and I think some of the points you said about supply, we have to remember that supply leaving faster than demand necessarily erodes at times. And again, we're at the softest point of the year, theoretically, pending any other situations. But trend line, this market's getting tighter. And I think my biggest takeaway here is that as spot rates approach that contract point, the market becomes increasingly volatile, increasingly sensitive.
Well, I think what you risk is if you're a shipper is spot rates do a run on them. And any commodity markets, anytime, the risk is actually on the upside of a commodity increasing. Like commodity collapses short of like a catastrophic tend to be, in commodity markets, they tend to erode a little bit slower than they had the tendency to go up, because all of a sudden when you have a short squeeze, you get both the shorts in the market that bid it up, but you also had this sort of awareness, oh my gosh, we may run out of whatever this is. And I think the same thing happens in freight, is whenever you have a situation, I mean, just look at that right back in 20. Go pull that chart back up, pull up rates right there. Go back to 20, see how fast, now it collapsed in 22, but see how fast that went back. You can have the same tendency. And I think the risk to a shipper is that they don't have a truck show up.
Yeah, they were lower than they were at this point. In April of 2020, I remember we had a debate in 2020
we did.
About the recovery situation. And my goodness, I have never seen, we saw rejection rates and spot rates increase through about a 4 or 5 week period there.
It was insane. I mean, it was a great time to be in the industry, but nobody, I mean, it was really, there were people that were still talking about softness. I remember we had a trucker recruiting summit, and it would have been early August, I believe, of 2020. This is when we joined a lot of virtual events. And it was weird because they were actually, and this was August of 2020, they were talking about still getting rid of drivers. The fleets had such an influx of employment, truck drivers, because people, their other jobs were still struggling. This is really at the sort of early parts of the recovery. And this is before the employment market really tightened, but there was a surplus of truck drivers. And companies were not just, they weren't recruiting anymore because they didn't have to. And what was happening in that period of time is that there was just an excess amount of truck drivers available for hire. That flipped really quick. In 2 months, it was on. And it is already starting to build. If you go look at the data, you can see it clearly was happening as early as April. But now what we're seeing is a situation where the market is recovering. I don't have anything, I have been asked this recently, why am I not talking about the freight market? I've been busy the last couple weeks. It does not change my thesis. My thesis is that the freight market is recovering. We're still in a recovery cycle. And in spite of all the noise around the economy, and there's a lot of reasons to be cautious. There's a lot of things that could happen in the second half of the year, or even the next couple of months, that can give you reason to be a little bit cautious. I still think that the second half of the year will continue to get better.
Yeah, I think we're still on schedule here as the rates chart showed. Well, I want to leave time for some Q&A, so Julia, let us have it.
Awesome. Yeah, thanks, Zach. We are going to go through as many questions as we have time for. Enter those in that Q&A box. We've already got a lot of great questions, so I'll jump right in. Building on what you were just talking about, Victoria asks, should the general consensus view of a freight recovery happening in 2025 be adjusted now that we're 2 months into the year with some lackluster results and less than exciting forecast?
No, I don't think so. I don't think my sense has changed at this point. It's always hard to draw conclusions on January and February data, and it's easy when you're in the middle of these like real soft periods to get overly down and depressed and sad about where things are at and think, okay, we're going to be in this for a while. Like the thought has certainly crossed my mind is like, man, I hope that we see a recovery quickly or we see a sort of increase of the trend line. just because nobody likes this period of time. But nothing has changed in my thesis at this point.
Oh, 100%. I think I've written it twice now in our daily watch for the Sonar subscribers. Don't overreact to these market downturns in January and February.
They're not that sharp. If you look at historical, if you take a longer period of chart, sort of a long sort of view of this, they're actually not that. Like, we're way up from where we were a year ago.
Yeah, the long-term trends are still completely in play. And the rejection rates being above 5% still, regardless of this demand-side downturn, and everything you just talking about supply is also limited in this environment.
And it will continue to limit.
Yeah.
And I do think immigration, as that becomes a continue to play out, I think all of those things are going to continue to be a factor.
They're gonna mute each other. If demand is muted because of reasons, it's not gonna make that sharp turn as evident.
And I don't think, one of the things that I think is interesting is what happens. I'll get your take on this. What happens with these government layoffs? Do they end up entering truck driving jobs?
I know. I mean, that's not
It's not the same job.
Yeah.
I don't think that they enter the workforce.
It takes a special type of person to be an over-the-road truck driver.
Yeah, I don't think that we're going to see a bunch of government.
Somebody that's been sitting in a back office.
No, they don't even go into the office.
Not the world traveler that the truck driver, the adventurous spirit of the truck driver.
I don't think so. I think, but I do think it could help inflation. Like, it could actually ease up in some of the employment markets in white-collar jobs.
Sure.
And when you see that could help service jobs and white-collar jobs, could ease up on some of the sort of labor inflation that we've seen at the margin. That could help, which I think is the case that they certainly have made. That could certainly help some of the inflationary facts, which will take. I mean, one of the reasons that we haven't seen a drop in interest rates is because there's the bond market is forecasting. They were going into the Trump administration forecasting much stronger inflation. And the reason that they've gone into is because Donald Trump has a history of these big, expansive spending programs combined with big tax cuts. What we have not seen is the big spending increases that I think most people have sort of looked at the first Trump administration was sort of a hallmark of it. That isn't happening this time around. And so the bond market, as it starts to price in these conversations, may end up taking, if we actually see real effectiveness with DOGE, which is still a question, if we actually see it happen, then we may see that the bond market starts to say, okay, we can let off the inflation number.
Right.
Also, the Russia-Ukraine war has been an overhang on inflation for some time. Assuming that gets resolved sometime this year, I don't know that it will, then we also could see a situation where we could see less inflation on that side of it.
This next question here is from Nico, who asks, what do you think about the future of the EPA's fuel economy standards for heavy-duty vehicles finalized in 2024? Will this stand, and will OEMs prepare for this?
No, it's not going to stand. No. I think, look, there's one thing, a lot of things we could say about Donald Trump's policies that are unpredictable, but there is certainly, he has a very specific pattern as to what he likes and does not like. And you pretty much know what those things are. I think we're always surprised at some of the methodology and how fast or unpredictable things go into effect. But he has made it very clear that electric vehicles and the electrical vehicle mandate and decarbonization is his enemy. He has been very anti any of the policies that he viewed that, and the Biden administration was largely pro decarbonization, and EVs were an instrument of that. Donald Trump was very clear that he is that is not his view, and I think the EPA administration, the rules associated with it, are going to get overturned, and I don't expect that to be.
I 100% agree. And a lot of the policies that we hear from the Trump administration somewhat conflict with each other. That's why we get some of these mixed signals at times. This has been one that doesn't have a counter argument in a lot of his policies. So I think this is a pretty straightforward, sometimes you throw the economy in there as like an offset of immigration policy, but this one is very straightforward. This is not something that he supports in general.
Great. Next question here is from Lisa, who asks, what should shippers be looking for in a freight brokerage partner in 2025?
Hey, same thing is that you would always look for is ability to provide capacity,
Strong carrier base.
And the ability to respond to market cycles. Like one of the things that you want is someone who is managing your capacity at a rate that you like, and who's not going, if the market does turn up, is not going to reject your freight because they miscalculated the pricing.
Yeah, I think a lot of the traps that brokerages can fall into is they try to win the business today, which they have to do from a financial business standpoint. But if they get too ingrained in that strategy of that price first mentality, they leave themselves exposed to these market directional shifts, some of which can be very dramatic and rapid, as we just talked about. So you definitely want to have one that's not that is there not simply just trying to win business purely on that level, but they need to have a good solid base of relationship with a transportation service provider.
Great. Next question.
One last thing, fraud. Don't forget fraud.
Oh, yeah,
You've got to be managing. We have a fraud summit coming up, by the way, in May.
Okay, well, plug it.
FreightWaves is hosting a fraud summit in Dallas, Texas, where we will talk about freight fraud. It's a massive problem. It has continued to become a bigger problem, and one of the things we're going to try to do is dive into what is causing it, best practices, and hear from a number of thought leaders on that. But certainly, if I am going to be doing business with a broker, then I'm going to be making sure that they have very good processes and policies to manage fraud.
Yep.
And in the inevitable, which is inevitable if you do enough transactions, when something does go wrong, what is their process for handling those situations and recovering my freight? So I want to know on the front end, how are they vetting? I want to know on the back end, what are they doing to recover it? And how would they handle it? And do they have the infrastructure that if my cargo theft is stolen, is there enough financial viability of that broker that if I have to go after it from a claim standpoint, that they can stand in for it?
Great. My next question here is from Michael, who asks, what are some key trends that you guys think will emerge in the truckload market as we move through a volatile 2025? And how will carriers and shippers adjust strategies to manage within that?
Man, I think, one of the trends that we've been watching is the intermodal component being really dragging the demand side of the trucking sector. I'm watching to see how that sustains. A lot of shippers have shown that they're okay with some level of dwell time increase, service deterioration, as they kind of have this rolling storage situation moving. How long does that persist? Because if that network falls apart, and shippers back during COVID, the difference was they had to have their freight there moving as fast as possible. It was very much like we have to have it today. Right now, that's not the case because the order lead times have increased so much. If we see any kind of disruptive force in that space, the truckload environment could get a lot of injection from that. That's going to be one that I'm watching is how is the intermodal and trucking situation standing up? And the second one is this short haul trucking movement going to continue? And I think the first one has a lot to say about the second one, is that a lot of the trucks are being utilized for much shorter movements around these cities. And that's going to change the way that a lot of these carrier networks operate.
Yeah, and the flow of cargo is also important.
Yeah.
Like intermodal is largely a west to east, or is certainly north to south or south to north traffic as part of that. But it's really predominantly the volume is in that west to east lane. One of the challenges is the balance element.
Yep.
Is it's largely predicated on inbound containers from China moving freight off the West Coast across the country. If we do see a fundamental shift, you asked what was different between what we expected. I think one thing that has caught us off guard, sort of got me off guard, is Trump's attacks on Canada and Mexico.
Yeah.
I think I certainly didn't expect to see the first set of tariffs first was towards Colombia, but that was very transactional. The first sort of like big tariff change was actually Mexico and Canada. Right. I didn't expect that to be sort of target numero uno, and I would have expected that Mexico and Canada would have been a beneficiary of the Trump economy and reindustrialization, and I don't know. I still think that's the case. But I think that's been one of the surprising things. And what happens with freight flow is it shifts, right?
Right.
Like if we had a pro North America and we sort of treated Canada and Mexico as part of that broader system, then I think you could make the really strong bull case on I-35. It's a little hard to make that right now.
Yeah, freight flow is the biggest trend, and everything that we just talked about was the same thing, effectively, in terms of supply chain reorganization and how freight is moving throughout the United States and, of course, North America. People aren't, they've been diversifying their supply chains for several years now. This is not new, but I think, to your point, Canada and Mexico were places that people thought were safer.
Sort of sanctuaries
Yeah.
of outside of that. That doesn't appear to be the case.
Yeah.
I think that you asked what surprise has been surprising. I think that's probably the biggest surprise. Most of the other stuff has been somewhat predictable.
Yeah.
The speed at which maybe, but
Right.
Great. Next question here is from Rob, who asks, Zach, is the ratio of spot to contract loads still running at about 10% spot and 90% contract?
That's I haven't looked at that number specifically for a minute, but the spot market is interesting in the way that it will grow in periods of softness because you can get such a heavy discount. And I would expect that number probably declined a little bit as the spot market has actually kind of become closer in alignment with the contract market. That would be my take, is that it was roughly around, we've seen studies that suggested at some points that the spot market represented upwards of 33% of the total.
I think it's closer to that.
Yeah.
I don't think it's 10%. It hasn't been 10% for some time. I think it's around 30.
Yeah, I would.
Some folks have said it's as high as 50. I don't know if I.
No. It's the larger shippers. The shipping community largely does not like to operate in the spot market in general. So we've seen them they really still haven't been a huge growth in the spot market activity, even as they've been getting some of these discounts. And as the market's become increasingly volatile, I would have said that would have become a diminished component of a lot of these shipping.
It also depends on whether you're talking spot or freight handled through brokers. Because intermediaries, not all freight, and now a large percent of freight that brokers handle is not actually spot freight. So if you take the spot number, say a third, you still, maybe your 10% number is closer, is a large portion of that is contract freight that happens to go through a broker.
Yeah, and that's not spot freight in our opinion.
Great. My last question here. What are the key challenges a new freight brokerage should anticipate in its first year, and what strategies do you recommend to build a strong carrier network?
It's all, I hate to say this, relationship, but also knowing that you're paying a fair market rate. I think there's a couple of things you can do as a broker to build relationships with carriers. One is, don't play the games, pay attention when it's due, give them the information, don't harass them to get updates when nobody wants to be hounded. Like, one of the things I hear a lot of these visibility apps, these tracking apps, and they're like, well, the driver will go and do the work, download the app, and the app is updating, but then they're still getting calls from the check department to find out if they're on their way because they don't trust the app. That's a problem. And so I think ultimately pay your carriers on time. Don't play a lot of games with payments, particularly things like detention. If you collect it, if the shipper's paying it, you should pay it. You shouldn't feed off the trough of that as much as possible. And have good, high quality paying freight that isn't a lot of problems. Like, you want freight that drivers want to haul and carriers want to haul. And if you give them a load that creates a lot of frustration, then they will forget what they made on it and remember that you're the jerk that gave them the load in their mind. I'm not saying you are, that's how those would think of it.
Yeah, I mean, I've said it a lot. Trust is expensive. If you can't trust each other, the relationship is very costly and expensive, and it's not sustainable. Everything Craig said, make sure that you don't play a lot of games. There are a lot of brokers out there now, but your value to the carrier is that you can go out and find business for them. Know that is what your role is with that relationship, and make sure that you're giving them, some of the freight that you come into contact with isn't going to be pristine, but make sure that you're aware of that and are able to reflect that with your carrier.
And like, if you have a difficult load, be honest with the driver. It's like this, one of the worst things I think you could do is get it. And I get it. You're trying to get a driver to take it that doesn't, and you don't necessarily want it to be so obvious that it is a problem child or fugly freight. And then they get it and they end up presenting you no matter what they get paid.
Yeah, you can play that negotiation game in the short term and win, but if you want to have a sustainable business model, you're going to have to build that trust between the carrier.
Awesome. Well, it looks like that's all of the time we have for today. Craig and Zach, as always, thanks for being here with us this afternoon. We appreciate you, our audience, for asking so many great questions, participating in this event every month. Make sure to mark your calendars for next month's State of Freight webinar on Thursday, March 27th at 2 p.m. and visit live.freightwaves.com for more great events. Thanks, everyone.